What's up guys? In today's video, I am going to try my best to explain what universal life insurance is and how it works in Canada. So with that, let's just jump right into the video. Okay, universal life insurance is a form of permanent life insurance. And now there's two different kinds of permanent life insurance. There's whole life insurance and there's universal life insurance. And I did another video on whole life insurance and you can watch it up there if you're interested. By the way, I should note, I'm only going to be explaining the mechanics of universal life insurance, the features, how it works, how it's supposed to work. I'm not going to be trying to explain who this is right for, if you should buy universal life insurance. That's not what this video is about. I will be making another video and hopefully it's already made by now. And if it is, I'll put it there, which is the best life insurance for you, how to buy it, how much you need, etc., etc. That'll all be in that video, especially which life insurance coverage is best for you. In this video, I'm only going to be explaining the mechanics of universal life insurance and how it works in Canada. So universal life insurance is just a permanent life insurance policy in Canada. It has a death benefit just like whole life insurance or term life insurance. It's easy to understand in that regard. It's meant to be a permanent life insurance policy that will last until you die. And now whole life insurance is a much more guaranteed option where you have a set amount of time where you pay the premium. It might be 10 years, 15, 20 years, and then it's paid off and you're done paying it. And everything that happens behind the scenes, I'll say, with the cash surrender value and all the other things, that happens, we'll say, kind of in a black box. The insurance companies, they do their own thing, they manage the returns, everything happens. It's not exactly clear exactly what's happened in a whole life policy. It just happens and they say, okay, here's your return, here's your dividend, you can receive it. Universal life insurance, however, is much more transparent, it's more flexible, but with that, it becomes a lot more complicated and the need to manage it is a lot higher. Now, universal life insurance has two different components to it. There's the cost of insurance and then there's the investment account, okay? Now, with whole life insurance, it's called cash surrender value. With universal life insurance, it's called your fund balance or your account balance or fund value, and it's a separate account. With whole life, you're essentially letting the insurance company manage it. With universal life, you and the advisor are the ones that manage this investment account. So first, let's talk about the cost of insurance and then we'll talk about the account. So universal life insurance has two different types of cost of insurance and it's not fixed. And what I mean by that is you can change it and there's some strategies where you should change it, okay? So the first one is called YRT or yearly renewable term. And what this means is the cost of insurance is calculated in any given one specific year. So let's say you're age 30 and you buy a universal life insurance policy. The cost of insurance is going to be calculated in that year. So they're going to take your age, your mortality, your health, all that in that one specific year, and that's going to be your starting point. And then the next year, it's going to be based on a 31-year-old, and the year after a 32-year-old, a 33-year-old, a 34-year-old. So what's good about this yearly renewable term is that essentially your cost of insurance is going to be very, very low in the beginning, and then it's going to increase over time. So think about it kind of like term insurance, and then you have this portion that's invested. So, okay, that could be a good idea. The second one is now level cost. And level cost is essentially the same price. It's never going to go up. It's the exact same. So they say level cost to 100, for example, age 100. And that means that they're going to base the cost on, let's say, you as a 30-year-old, and that's going to be a fixed cost. So with the yearly renewable term, maybe the cost of insurance is $15 a month in year 30, but level cost is $100 a month. This is just a hypothetical example. The $15 yearly renewable term is going to increase over time until either it gets so high you can't afford it, or you switch it over to a level cost, and that level cost might be at age 40 or 45 or 50. So that's just a general idea of the cost of insurance within a universal life insurance policy. You have yearly renewable term and you have level cost. And I'm gonna explain at the end of this video why I have a little bit of a problem with universal life and how you can buy it correctly and make sure that it's the right product for you, okay? So I talked about cost of insurance. Now let's talk about the actual fund balance or account value. By the way, before I go on, I do wanna tell you about Affinity Life. Affinity Life is an online life insurance brokerage where you can view quotes and apply 100% online. So if you're interested in find out more information about that or getting free online instant life insurance quote, just click the link in the description below and you can get some more information on that. Okay, let's talk about the account balance or fund balance or fund account or whatever it's called, whatever they want to call it, okay? You can most easily think about this like This is essentially an account that you can manage, so you can pick the investments within the account, pardon me. You can choose the asset allocation, so maybe more equities, more fixed income. It's the same type of investment account as you would with an RRSP or a TFSA, okay? Now, the growth within this investment account can be tax-free up to certain limits. If you go over that, it can be taxable, but essentially if you stay under it, it can be tax-free, which is good. So you and your advisor, hopefully, will manage this investment account. You'll go through it, you'll say, you know what, I wanna do a 70% equity and a 30% fixed income. I want a lot of growth within this policy, and it can be managed over time, and this can all grow tax-free, which is really good, okay? However, something should be noted. This account needs to be managed. It's not just a set it and forget it thing. So again, this is a little bit of a problem I have with this is a lot of advisors that come into the insurance industry, they come in, they make a splash, they sell a lot of policies, and then they get out. And you have clients that are now left with these universal life policies. They don't know how to manage them. They don't know how to change the investments. They don't even know what the investments are in. So making sure this investment account is managed and you understand it as a client is really important. So not only can this account have gains, it can also have losses as well. It's exactly like any other investment account. If the market is down, you're gonna lose money within this account, and if it's up, you're gonna gain money, obviously. Now you're probably wondering, what can you do with this investment account? Well, I talked in the whole life video, and I'll make another video, by the way, about how to access the cash surrender value or the fund account if it's a UL. And I'm gonna make another video, and if it's already done, I'll put it there. It's gonna be called Is Life Insurance an Investment? Because I know a lot of people talk about that. You can access it essentially the same way you can access the cash surrender value in a whole life policy. So that could be surrendering the policy and they pay it out to you. You could get maybe a policy loan, you could get a collateral loan. There's different ways to access it, but I'll make another video about that. But the idea of a universal life policy is this. You want to pay the premiums for the cost of insurance, and you want to grow this investment account. And over time, you want the investments to be making enough returns that they can start to pay for the cost of insurance. So you're able to manage this policy a lot better than a whole life. Whereas a whole life, it's kind of a fixed amount. It's just, that's it. They take care of it. They handle it. You want it paid off in 20 years, done deal. A universal life is typically gonna be cheaper dollar for dollar than a whole life policy. The difference is now it needs to be managed more. It's way more flexible. A lot more things can go right, but a lot more things can go wrong. Now, let me quickly explain the general idea that most people want to use, a universal life insurance policy for, and why I have a problem with it. And I might be biased. I've been in the insurance industry for about 7-8 years now, and I've just seen a lot of universal life policies incorrectly sold, and I've seen the problems that they cause in families. And let me explain this to you, okay? So here's the idea of a universal life policy. Let's say you're a 30-year-old male, husband, you're a father, you have a family, and you get approached by an advisor who says, you know what, I think you should get this universal life policy. It's gonna protect you right now. The cost of insurance is low. You can put in a little bit on the investment side, or you can put in a lot. It's up to you. You can grow this for the next 20, 25 years. And then listen, at that point, the premiums are then going to be paid for by the investment account. You don't have to pay it anymore. Covered your life insurance needs during the time when your kids were growing up and you had a mortgage and you had debt and you wanted to get these things covered. And then now you have this permanent life insurance coverage later in life. So this advisor sells you a YRT, a yearly renewable term. The premiums are quite cheap. Maybe the cost of insurance is only $20, $30, and he says, why don't we put $100 in? So $30 goes to pay for the cost of insurance and $70 goes to this investment account, and we're gonna manage it. And eventually down the road, we're gonna switch this to a level cost. We're gonna essentially fix the amount, the cost of insurance, pardon me, and then we know exactly what it's gonna be until you die, and we can really work on growing that investment account to the point where this is now paid for by the returns. That sounds good in theory. Sounds really good in theory, okay? But listen, this is what I've seen. This is real world examples, and I've seen exactly this happen where I go to a client's house and they were sold this universal life policy 20, 30, 40 years ago, and they say, listen, Philip, okay, so I have this universal life policy. The guy that sold it to me, he says that I paid $100 a month and eventually one day it would be paid off, and I'm just wondering why it's not paid off yet. And I'm also wondering, I'm getting letters from the insurance company and they're saying that I owe like $10,000 for the year. Here's the thing. One, if you never switch it to a level cost, that yearly renewable term is gonna keep increasing every single year. And this guy's premiums were like $1,000 to $2,000 a month. And then it would go up double again at 64, 65, 66. So the advisor that originally sold it to him, and this is most of the case. I mean, most advisors don't stay in this industry. And it's not because maybe they don't want to, it's just that it's a hard industry to stay in, so they quit. And now you have these policies that need to be managed by the advisor, at least very understood by the client so they can manage it themselves. It's very complicated products, and they don't. And so I have to tell the guy, listen, there's no money here. You can't switch it to level cost now. It would be like $50,000 a year. All that money that you put in is now lost. There's not much that I can do. So, yeah, is Universal Life a bad product? No. Is it sold incorrectly? Yes. Does it need to be very carefully managed by both the advisor and the client? Yes. I hope that this video didn't complicate things more for you than it should have. It's obviously, there's a lot more that I can say than I have, but this is a nutshell. What is Universal Life Insurance Canada? I hope you guys enjoyed this. If you guys are liking this content, give it a thumbs up, and I'll see you guys in the next one. How it's supposed to work. I'm not gonna be trying to, if the market is down, you're gonna lose money within this account, and if it's up, you're gonna gain money, obviously, okay? Now it needs to be managed more, it's way more flexible, a lot more things can go right, but a lot more things can go wrong, okay?